Welcome back to the Deep Dive. Today, we're really embarking on, I think, an essential mission.
Mm-hmm.
We're going to dissect this core conflict right at the heart of the digital asset space. We're looking at sources, exploring that big tension.
Yeah, the tension between Bitcoin's original idea, peer-to-peer electronic cash,
Right.
and what it's mostly become culturally, this digital gold idea, just a long-term store of value.
And that tension, that constant sort of tug of war between saving it, HODLing, and actually spending it.
It's not just some, philosophical debate, is it? It feels almost existential for Bitcoin.
It really does. So our deep dive today, it's aimed right at you, our listener, because you follow this stuff.
Yeah.
We want to figure out exactly how this choice, HODL or transact,
Mm-hmm.
how that dictates the asset's utility.
Yeah, its ability to scale, and really, the big one, its path towards mass adoption. Can it be everyday money?
And the central paradox, the thing that really grounds this whole conversation,
Yeah.
is that the system, Satoshi's white paper, it was built for transactions. But the success story we tell, it's almost entirely built on not transacting, on inactivity.
It's kind of wild when you put it like that.
We love that HODL culture drives scarcity, drives the price up. We all check the charts.
Mm-hmm.
But if we only treat it like this appreciating savings account,
Are we accidentally just sort of glutting its chances of ever being that global transaction layer?
exactly. How do we keep that investment idea alive, the number go up part, while also, feeding the transactional engine? That's the mission today. Okay, so let's maybe unpack this core issue first, this fundamental trade-off
Right.
for, the last decade. The main story has been Bitcoin's #1 job is store of value, digital gold, driven by that mathematical scarcity.
Yep. And the logic follows. The more people HODL, the fewer coins are floating around, circulating.
And the higher the price goes. It's presented as this, beautiful, almost automatic mechanism.
It is appealing. But the question is, what price are we paying for that? What does that long-term saving strategy do to the short-term usability, the day-to-day function?
Yeah.
Well, it's almost a textbook case, isn't it? Where the asset's perceived value starts to cannibalize its actual intended use.
How so?
HODling is the engine driving scarcity. That's undeniable. When long-term holders, pull their coins off exchanges, lock them away in cold storage for maybe years.
For restricting supply.
Exactly. Which lines up perfectly with that digital gold story, the stock-to-flow models, all those predictions of huge price targets.
And if you're just an individual investor focused only on number go up,
Then HODling is completely irrational behavior. Why spend something you think will be worth way more tomorrow?
and here's the kicker. If everyone follows that perfectly rational individual strategy, then bam, you run smack into the utility paradox.
Explain that.
Well, look, the whole point of a payment network, any payment network, is utility. And that comes from transaction density. Lots of payments happening all the time.
If, say, 99% of all the Bitcoin is just locked away, gathering digital dust in cold storage,
Transaction volume plummets.
right down to almost nothing potentially. And if that happens, the entire business case for anyone or merchant, a payment processor to accept it just collapses.
Why bother?
Precisely. Think about a big retail chain. They got to spend real money, time, resources to integrate a new payment system, training staff, compliance checks.
It's a whole project.
Huge. And if, after all that hassle, they only see one Bitcoin payment every 3 months.
It's a money pit.
Yeah.
The integration is a liability, not an asset.
Exactly. It's a sunk cost with zero return.
And, okay, this brings us back to that, famous or maybe infamous economic idea. Gresham's law.
Yes. Bad money drives out good.
We hear it all the time in crypto, right?
Yeah.
The idea is people hoard the good money, the appreciating asset Bitcoin, and they rush to spend the bad money, the depreciating stuff, fiat.
Mm-hmm.
So does that old law fit perfectly here? Is that what's happening?
Well, the sources we looked at, they bring in a really crucial nuance here. And this is where we have to, look a bit deeper than just the catchphrase.
Okay.
Historically, Gresham's law usually worked in systems where using or converting currency was, mandated by the government.
Right, like a fixed exchange rate.
Exactly. Think of a bimetallic standard, gold and silver coins. If the government set the price of silver too low compared to its market value,
People would hoard the silver coins or melt them down.
yep, the state's own pricing structure forced the good money out of circulation.
But that's not quite our situation today, is it?
No, it's different. Today, fiat currencies and Bitcoin just coexist. And for most people, certainly in developed countries, the choice to spend their dollars or euros, which are losing value slowly.
Or spend their Bitcoin. which they hope is gaining value.
The choice is completely voluntary. There's no government mandate forcing one out.
So the bad money, the fiat, isn't technically driving the good money out.
Not in the classic Gresham sense. It's more like the individual holder is voluntarily pulling the good money Bitcoin out of circulation.
Because of the investment potential.
Exactly. It's an investment strategy. A rational one, maybe, for the individual, but it's one that collectively stifles the transaction density we need.
So the end result looks similar, lack of circulation,
Mm.
but the reason behind it is different. It's behavioral choice, investment math, not a government rule.
Precisely. And that means if we really want Bitcoin to succeed as actual cash, we need to figure out ways, maybe behavioral nudges or structural changes.
That makes spending it also a rational, useful choice, right alongside saving it. Okay, so the need for transactions seems clear to avoid that paradox. But let's get fundamental. Why must transactions happen for Bitcoin to move beyond just being, a speculative thing held by institutions and HO dealers?
Why isn't just big money buying it enough validation?
Yeah, why can't institutional buys and custody solutions alone prove it works?
Because, well, institutional investment validates Bitcoin as a store of value, maybe digital gold, but only actual transaction volume validates it as a functioning medium of exchange, as money you can use.
Okay.
It really all comes down to the merchant's viewpoint and the practical justification for them to even bother integrating it.
The ROI argument again.
Exactly. Retailers need to see a measurable return on investment. Think about all the costs involved for them.
We touched on it. Integration, training.
API license fees, constant compliance monitoring, which changes by region. Remember, employee training on handling crypto wallets, security protocols, even managing the risk of price swings between accepting the payment and settling it.
Wow, yeah, that's a huge list of operational hurdles.
It really is. And if the volume, the number of transactions, isn't there to offset those costs and hassles?
The whole integration effort is just wasted money and time.
Absolutely. That high barrier to entry for merchants, it's only ever going to be justified if there's high velocity. Lots of people actually wanting to spend it.
So spending is like real-world proof.
Undeniable proof. It's evidence of utility that goes way beyond any white paper, any investment thesis, any billionaire tweeting about it.
Okay.
Spending demonstrates to banks, to nervous regulators, even to competing businesses, that there's real consumer demand here. People actually want to use this thing for everyday commerce.
And without that proof,
the whole system stays kind of fragile, doesn't it? It relies entirely on the hope of future price gains, not on any, foundational economic activity happening right now.
and we don't need to just talk hypothetically here. We've got a pretty stark real-world example, right? The PayFast case study out of South Africa.
Oh, yeah. This one perfectly illustrates what happens when the HODL culture just completely dominates utility.
Tell us about PayFast. What happened there?
It's really a cautionary tale. Should be required reading for anyone thinking about crypto adoption. PayFast, they're a pretty big deal, a major South African payment gateway. And they were actually quite forward-thinking.
We got it early.
Super early. They integrated Bitcoin payments way back in 2014. Enthusiasm was high then, lots of buzz. They were building the rails.
Okay, so they were pioneers.
Definitely. But then, just 5 years later, in 2019, they made a public announcement. They were dropping support for Bitcoin entirely.
Wow. So what was the official reason? Why pull the plug after investing in it?
And this is the crucial part. It wasn't because of regulators cracking down. It wasn't a technical glitch or security breach.
So what was it?
Purely economics. Low usage volume. Simple as that.
Nobody was actually using it to pay.
Well, not enough people. The sources we looked at confirmed the transaction density was just so low that the ongoing costs of keeping it running, maintaining the specific code for Bitcoin payments, managing the security side, dealing with the inevitable customer service questions that pop up.
Just wasn't worth it financially.
Exactly. The costs outweighed any revenue or benefit they were getting from it. They had to pull the plug because the users, in what was a relatively stable economy compared to some neighbors, they overwhelmingly chose to HODL their Bitcoin, hoping it would appreciate rather than spend it.
So the inertia of saving just crushed the need for spending, in that market at least.
Perfectly put. And the wider impact of a decision like that, it can't be overstated.
How so?
Well, when a major established payment processor, especially one known for being an early adopter, publicly retreats like that.
It sends a really bad signal.
A powerful negative signal to every other retailer, every other payment gateway around the world who might be thinking about integrating Bitcoin.
It basically says this technology isn't ready for prime-time commerce.
Exactly, or at least the demand isn't there yet. It creates this chill, this merchant confidence failure.
So PayFast is proof that just building the infrastructure isn't enough.
Not even close. Infrastructure needs fuel. It needs transactions flowing through it to survive. The PayFast story confirms that this HODL paradox we're talking about isn't just academic theory.
No, it has real, direct, and pretty damaging consequences for adoption in the real world.
Absolutely.
Okay, let's shift gears a bit. Let's move away from these developed economies where, HO dealing is largely a strategic investment choice.
A luxury, almost.
Yeah, a luxury.
Yeah.
Let's look at regions where economic reality just strips that luxury away completely.
Right. Where Bitcoin isn't about getting rich, it's about getting by.
Exactly.
Yeah.
Because here's where the story of Bitcoin as a transactional tool really comes alive, isn't it? In places fighting hyperinflation or where the local currency is just collapsing, spending Bitcoin isn't a choice between potential gains and a cup of coffee. It's actually a means of financial survival.
Yeah, this contrast is so important for understanding Bitcoin's dual personality.
How do you mean?
Well, in markets like the US or Europe, holding Bitcoin is mostly about optimizing your investment portfolio, right? Managing capital gains.
Sure.
But you go to places grappling with serious inflation, think Argentina, Zimbabwe, Nigeria, Venezuela, even parts of South Africa we mentioned.
Okay.
Using Bitcoin or often stable coins built on similar rails, it's about preserving the value you need for tomorrow's food. It's about survival.
So when your local fiat currency is losing, say, 5% of its purchasing power every single month,
You have a massive, urgent incentive to get your value out of that collapsing currency immediately.
and move it into something more stable.
Right, which in many of these places turns out to be Bitcoin or maybe a dollar-pegged stablecoin. You hold it there just to stop the bleeding.
So the actual spending we see there, the transactions,
Yeah,
it's not speculative churning, it's essential stuff.
totally. It's paying rent, buying groceries, sending money to family across borders. Remittances are huge.
Real utility.
Absolutely. And this usage is organic. It's urgent. It's sustained day after day. People are actively spending Bitcoin or stablecoins because holding the local currency guarantees you lose money.
Can you give an example?
Sure. Think about a merchant in, say, Nigeria, selling maybe imported electronics or something durable. They might actually start pricing their goods in Bitcoin.
Not in Naira.
Right. Because they literally can't trust that the Naira they receive today will be enough to buy replacement inventory next week or next month. Inflation is eating it too fast.
Wow. So that forces a kind of circular economy, doesn't it? Driven purely by the need to escape inflation.
Exactly. Necessity becomes the mother of adoption.
And the sources we looked at, they also frame this kind of necessity-driven spending as something more, like a political act.
Yeah.
How does that work? How does using Bitcoin in these places actually put pressure on regulators?
Well, it fundamentally shifts the power dynamic, doesn't it?
Okay.
When using Bitcoin becomes essential for financial survival, like when people are using it to send remittances home, bypassing strict government capital controls, or when local shops start pricing basic goods in BTC because the fiat is worthless, what are they doing? They're essentially building an independent, parallel financial system.
One that operates outside the government's direct control, outside their ability to inflate away savings or seize funds easily.
Precisely. And this activity, it's not hidden. It's measurable on the blockchain. It's undeniable. It's happening out in the open in marketplaces.
So regulators can't just ignore it or dismiss it as some fringe tech thing.
Not anymore. Not when their own citizens are relying on it daily just to function. It forces them to confront the reality that Bitcoin is already acting as a primary medium of exchange for a growing number of people.
So it forces recognition, but from the bottom up, driven by the users, not by some top-down government decision.
Exactly. It doesn't matter what the official political stance is initially. This real-world usage pressures local banks that have to figure out, okay, how do we interact with this stuff? It pressures the central bank to at least acknowledge its velocity and impact.
That seems like the ultimate proof of utility, right?
Right.
When it works precisely because the traditional system has failed people.
Couldn't have said it better myself. It operates where the old system has broken down.
So if this necessity is driving usage, how do analysts actually measure this specific activity? How do you separate it from, big HO dealers moving coins or exchange activity?
Yeah, that's key. We rely on pretty granular on-chain analysis. Good analysts have tools to filter the fire hose of data.
How?
They work hard to differentiate between what you might call whale movements. These are typically large, infrequent transactions, often linked to institutional custody wallets or big exchange balances.
Okay, the HODlers or traders.
Right. Differentiate that from the high-frequency, small-value transactions that characterize retail spending.
And you can see that geographically.
Increasingly, yes. In places like Nigeria or Argentina, if you see a sudden, sustained spike in the number of daily transactions, coupled with a decrease in the average size of each transaction.
That suggests lots of small payments, like buying coffee, not a car.
Exactly. That's a strong indicator of retail activity. We look at specific metrics like spent output volume broken down by geographic region, trying to isolate activity in wallets that show a high turnover rate coins coming in and going out quickly.
So a pattern of small amounts moving fast between many different user wallets.
That's your smoking gun.
Yeah.
That's a clear sign that Bitcoin is being used as actual cash, where its immediate utility is valued more than its potential future price gain.
Okay, that necessity case is really powerful. But let's swing back to the developed world for a minute, where the challenges are different, the barriers are more structural.
Right, where people could spend it, but often don't.
Exactly. If spending is so vital for the network's health, and we theoretically have the infrastructure like payment apps and processors, why do even the biggest Bitcoin fans in, say, the US or the UK or Canada still hesitate? Why don't they use that spending wallet more often?
What's the biggest single roadblock? Oh, without a shadow of a doubt, the number one structural problem, the biggest point of friction in most developed economies, is the tax compliance nightmare.
Taxes. Always taxes.
Yep. And it's not even necessarily the tax rate itself that's the killer. It's the sheer administrative burden it dumps on the average user.
Explain that. What's the core issue?
Well, take the United States as the prime example. The IRS right now officially treats Bitcoin not as currency, but as property, like a stock or a house.
Okay. And the implication of that is?
Every single time you spend it, every single transaction is considered a disposal of property, which means it's a potentially taxable event.
Wait, every coffee, every online purchase.
Every single one. Imagine you're trying to actually use your Bitcoin spending wallet, like cash. You buy a coffee, then you grab some groceries, maybe pay for a subscription online.
Dozens, maybe hundreds of small transactions over weeks or months.
Exactly. And for each one of those, according to the current rules, you are technically required to calculate the capital gain or loss you realized.
How would you even do that?
You'd need to know the price you originally paid for that specific fraction of Bitcoin you just spent and compare it to the dollar value at the moment you spent it.
That sounds impossible for small amounts.
It's incredibly burdensome, crippling, really. You have to track your cost basis for every tiny fraction of a Bitcoin. Did you buy the Bitcoin you used for that $5 latte 6 months ago when the price was $20,000? Or yesterday when it was $60,000?
Because the game is different?
Massively different. And if you've bought Bitcoin at multiple prices over time, which everyone does, and your wallet mixes those coins together,
Boy.
then you have to start applying complex accounting methods like FIFO first in, first out, or maybe LIFO last in, first out, just to figure out the tax liability for potentially hundreds of tiny spends over the year.
So buying a coffee turns into potential accounting homework.
Or worse, potential trouble with the tax authorities if you don't do it right. This level of compliance friction just completely obliterates the seamless, easy user experience that real cash needs.
Yeah, cash is supposed to be simple, instantaneous, no paperwork.
Exactly. This tax treatment is fundamentally at odds with the very idea of using it as cash.
Okay, so if that property classification and the resulting tax burden is the main barrier in places like the U.S., surely there's a regulatory path forward, a way to fix this.
Absolutely. And the good news is we're already seeing sensible solutions emerge. The sources point to clear, pragmatic regulatory fixes. Australia is a great example.
What did Australia do?
They implemented a really crucial exemption. They basically recognized that treating every tiny personal purchase as a capital gains event was unworkable and discouraged use.
Did they change the rule?
Yes. They created a rule where Bitcoin used for day-to-day personal purchases below a certain threshold. I think the figure often cited is around 10,000 Australian dollars per transaction is exempt from capital gains tax.
A de minimis exemption.
Exactly. That kind of regulatory clarity is a total game changer. Because it sends a clear signal to users. Look, for your everyday spending, your coffee, your groceries, don't worry about tracking the cost basis. Just use it. It removes that massive administrative roadblock for casual commerce.
It aligns the tax rules with how people might actually want to use digital assets as money.
Precisely. It seems like the most sensible path forward if you actually want widespread adoption for payments.
Okay, but until that kind of clarity becomes the norm in major economies like the US, which could take a while,
Could take a long while.
how does the average Bitcoiner navigate this? Someone who believes in the tech, wants to support the network by transacting, but also doesn't want to risk their main investment stash or get buried in tax forms.
Yeah, what can you, the listener, do right now? This is where that really practical, actionable strategy comes, and the one highlighted in the sources. It's called the two-wallet strategy.
2 wallets. Okay, sounds simple enough.
It is, conceptually. It's built on deliberately separating your funds based on their purpose and setting clear psychological boundaries for yourself.
Walk us through the 2 wallets. What are they and what do they do?
Okay, wallet number one is your savings wallet. Think of this as your deep cold storage, your long-term HODL stack.
The digital gold part.
Exactly. These funds are purely for preservation, for wealth accumulation. You secure these with the absolute highest security standards you can manage, maybe an air-gapped hardware wallet, multi-sig, whatever works for you.
And you don't touch it often.
Ideally, almost never. It's locked away, not exposed to online risks, and it represents that core investment thesis. That's the number go up stack.
Okay, got it. Savings wallet. What's the second one?
The second one is the key to actually making transactions feasible and less stressful. That's your spending wallet.
Okay.
Think of this like the cash you keep in your physical wallet or purse. It's a separate pool of funds specifically earmarked for daily or weekly transaction needs.
Coffee money, grocery money, online shopping money.
Precisely. And crucially, how you fund this wallet matters for managing that tax headache we talked about.
How so?
Ideally, you fund the spending wallet with fresh fiat deposits that you convert to BTC right before spending, or maybe with a small specific allocation of Bitcoin where you know the exact cost basis.
Ah, so you can track the cost basis for just that small amount, making the tax calculation way simpler if it's still required.
Exactly. It simplifies the accounting dramatically. But maybe even more importantly, there's a huge psychological benefit.
What's that?
By consciously setting aside a specific limited amount just for spending, you overcome that mental hurdle, that friction of feeling like you're giving up potential future gains every time you buy something small.
Because you've already decided this particular pot of money is for spending.
Right. You're not debating the investment case for your coffee money. You're just using the cash you allocated for transactions. It removes the decision paralysis.
Okay, that makes sense. But isn't there a security trade-off? Keeping a hot spending wallet, one that's online and easy to use, isn't that riskier than the cold storage savings wallet?
That's the critical risk management piece, absolutely. And the strategy inherently addresses this by limiting the exposure.
How?
Your spending wallet should only ever hold a relatively small amount of funds. An amount you could afford to lose, frankly. Maybe just what you expect to spend in a week or a month.
So if it gets compromised, it's annoying, but not catastrophic.
Exactly. It's easily replenishable. You wouldn't keep your life savings in your physical wallet, right?
Yeah.
Same principle here. This small sum may be held in a reliable mobile wallet or, even better, a Lightning Network wallet.
Ah, Lightning.
Yes. That provides the day-to-day utility you need without putting the vast majority of your wealth safe in the savings wallet at risk. And the goal really is for these spending funds to eventually flow mostly through layer 2 solutions like Lightning.
Because they're built for exactly this.
Yeah.
Fast, cheap, small payments.
Precisely. Lightning is designed to solve the speed and cost issues of on-chain transactions, making it perfect for that spending wallet use case.
Okay, the two-wallet strategy gives individuals a practical way to participate. But for spending to become more than just a niche activity for enthusiasts, we probably need more, right? We need actual tangible incentives to nudge people's behavior.
Yeah, to get them to choose the Bitcoin spending wallet over their default fiat debit card.
Exactly. What kind of incentives have actually worked in the real world to kickstart this?
Incentives are absolutely crucial, especially in the early stages. They're like the bootstrapping mechanism for any new payment network. And they work best when they make the crypto payment option demonstrably better, or at least cheaper, than the old way.
Got examples?
We saw some really powerful ones, again, in South Africa. Remember, PayFast pulled out due to low volume, while others tried to boost volume with rewards.
Like who?
The big national grocery chain, Pick n Pay, during some of their early trials with Bitcoin payments, they offered 10% cash back in sats.
Wait, 10% back paid in Bitcoin just for using Bitcoin to buy your groceries?
Yeah.
That's a direct, immediate economic motivation. You're basically getting a 10% discount just for using the crypto payment rail instead of your regular card.
That's pretty compelling. Behavioral economics 101, right? Immediate reward.
Totally. Reinforce the desired behavior with a tangible benefit. And the incentives actually got even more aggressive in some cases. Platforms like Binance QR payments, also in South Africa, were offering rewards of up to 50% back in sats for certain early payments.
50%? Wow.
Yeah, obviously not sustainable long-term, but as a short-term promotion, it directly drives utility, gets people over the hump of trying a new payment method, familiarizes them with the interface.
And crucially, it generates that initial transaction volume, the volume needed to convince payment processors and merchants that it's worth supporting the system.
Exactly, it kickstarts the flywheel.
Okay, so incentives help get individual transactions going. But the ultimate goal, as the sources seem to define it, isn't just random scattered payments. It's building something more systemic, right? A closed-loop system. That's the holy grail. The circular economy, an ecosystem where Bitcoin comes in, gets spent, gets earned, and circulates within the community without immediately needing to be cashed out to fiat at every step.
Where can we actually see this model working, not just in theory, but on the ground?
The prime example, the one that gets talked about a lot, and for good reason, is Bitcoin Ikasi in South Africa.
Tell us about Akasi. What is it exactly?
So Bitcoin Ikasi means township isn't some big corporate project or marketing stunt. It's a genuine grassroots community initiative. It's focused on a specific township near Mossel Bay.
And the mission?
The mission is explicitly to build a parallel functioning local economy that runs primarily, almost exclusively on Bitcoin, and crucially using the Lightning Network for most transactions because it's fast and cheap.
Wow. So what does daily life look like inside Bitcoin Akasi? How do they actually achieve that level of transactional density?
It really comes down to saturation and commitment within that community. They actively educate and onboard local merchants, everyone from the corner store owner, the barber, street food vendors, even local taxi services to accept Bitcoin, usually via Lightning wallets on simple smartphones.
So the places to spend it are readily available.
Yes. But here's the critical part for circularity. They also work to get local wages, stipends for community work, even tips for services denominated and paid out in Bitcoin.
So people are earning BTC locally.
And then they can immediately spend that BTC at the local grocery store, which also accepts it, maybe pay their rent in BTC to a landlord who accepts it.
So the Bitcoin stays within that local system, circulating between residents and merchants, before anyone feels the need to cash out to fiat.
Exactly. That achieves true high transaction density. The money is moving, providing utility, supporting the local economy without constantly hitting a bank or a fiat conversion bottleneck.
That really proves the concept, doesn't it? That a high-velocity, resilient Bitcoin economy is possible, at least on a micro level, if you have that social buy-in and the right tools, like Lightning.
It's a powerful demonstration, and it stands in pretty stark contrast to some of the, splashier corporate adoption attempts we've seen.
Like what? You mean like the Tesla example?
Exactly. Remember all the massive hype when Tesla announced they'd accept Bitcoin for car purchases back in 2021?
Huge news cycle.
Massive. And it certainly generated high transaction value because cars are expensive, but it generated extremely low transaction volume.
Right. Not many people actually bought Teslas with Bitcoin.
Probably very few, relatively speaking. And while those headlines are exciting for sentiment, a handful of huge multi-thousand-dollar transactions does absolutely nothing to build the day-to-day operational density or the payment channel liquidity that a stable payment network actually needs.
So Bitcoin Akasi, with its thousands of tiny daily Lightning payments, a coffee, a haircut, some groceries.
That's actually far more important, far more fundamental to proving Bitcoin's long-term utility thesis than a few Teslas being sold. It builds the base layer.
Okay, last point on this section. Why does building this stronger Bitcoin payment culture, whether it's through grassroots projects like Akasi or through broader incentive programs, why does that matter for the rest of the crypto and Web3 world?
Because that base Bitcoin payment layer, especially using things like Lightning, it really acts as the foundation. It's the bedrock upon which almost all other decentralized finance, Web3 payments, stablecoin usage, a lot of it is ultimately built or at least referenced back to Bitcoin.
How so?
Well, if users become comfortable, fluent, just used to using a decentralized cryptographic payment rail for simple everyday things,
Like buying lunch with Lightning.
yeah, then it dramatically lowers the mental barrier, the adoption friction for them to try related technologies. It makes using stablecoins seem less weird. It encourages the growth and use of the Lightning Network itself, which is vital for scaling Bitcoin.
It builds familiarity and trust in the whole concept of non-traditional payment rails.
Exactly. So conversely, a weak, unused utility layer for Bitcoin payments means a shaky foundation for the entire vision of decentralized commerce and finance. They're interconnected.
Okay, so we've talked about the need, the barriers, the strategies, the examples, but at the end of the day, the big question remains, is this spending culture actually making any headway against the deeply entrenched HODL culture?
Right. Are we seeing a real shift? How do we even measure that? We need to look beyond just the price, right?
Absolutely. Price tells you about investment sentiment, maybe, but to understand utility, we need to focus on specific, actionable data points, metrics that track this cultural evolution on the ground.
So if analysts are trying to gauge this balance utility versus storage, how do they actually quantify the difference? How much Bitcoin is just sitting there versus how much is actively being used for payments?
Yeah, the main tool here is analyzing unspent transaction outputs, or UTXOs, essentially tracking chunks of Bitcoin on the blockchain.
Analysts filter the total supply based on the age of these UTXOs, how long it's been since they last moved.
So you can see coins that haven't moved in years.
Exactly. We track how much BTC is sitting dormant in wallets for long periods, coins unmoved for 6 months, a year, 5 years, even longer. That's generally considered the HODL supply, or long-term holder supply.
Okay, the diamond hand stash.
Pretty much. Then you compare that relatively static HODL supply against the volume of coins that are moving frequently, especially those moving in smaller amounts associated with retail. That's your active payment volume indicator.
So what's the key signal you're looking for?
You're looking for an increase in the velocity of the circulating supply coins changing hands more often, even if the total HODL supply remains large or keeps growing. If velocity picks up, especially in smaller transaction sizes, it suggests the spending engine is starting to rev up, even while the savings function remains strong.
Right, but we know on-chain transactions for small payments are slow and can be expensive. So doesn't that mean we need to look very specifically at the tech built to fix that?
Absolutely critical. You have to look at the Lightning Network's growth. That gives you probably the most vital insight into the health of the actual spending infrastructure.
What specific Lightning metrics matter most?
You track several key indicators: the number of active Lightning nodes participating in the network, the total channel capacity, that's the amount of Bitcoin locked into Lightning channels, ready to facilitate payments.
More capacity means more potential payment volume.
Generally, yes. Higher capacity suggests more liquidity is available to route payments quickly and reliably across the network. And you also look at actual payment success rates and estimated transaction volumes on Lightning, although those are harder to measure precisely because it's off-chain.
So Lightning Network growth is basically the barometer for Bitcoin's potential as actual cash.
It's a huge part of it. This infrastructure, built for instant payments and tiny fees, is the direct technological answer to that utility paradox for everyday spending. If Lightning adoption is accelerating more nodes, more channels, more apps, more users, it means the structural ability to spend Bitcoin easily is maturing.
Okay, and what about tracking those necessity-driven markets we talked about? Places like Nigeria or Argentina, where utility is growing fastest out of need.
Yeah, you need to keep close tabs on those. Analysts maintain detailed on-chain activity analysis broken down by region. It involves sophisticated filtering to try and screen out noise from large corporate treasuries or exchange wallets and really isolate the organic, peer-to-peer retail activity.
Looking for those spikes again.
Exactly. Consistent, sustained increases in transaction density, more transactions per day, especially when concentrated in these inflation-hit countries, those are powerful signals.
And if those spikes aren't just temporary blips, but they continue over months or quarters.
Then it tells you something real is happening. That necessity is genuinely forcing users to integrate Bitcoin or related stablecoins into their daily financial lives. They're using it as money. And that provides the undeniable utility proof that maybe the rest of the world needs to see.
Okay, and finally, maybe the simplest metric of all, but maybe the most telling.
Yeah, the simplest one is just the merchant adoption rate. Pure and simple. Are more businesses, online platforms, payment processors adding support for Bitcoin payments than are dropping it.
Net additions versus net subtraction.
Exactly. The loss of PayFast back in 2019, that was a huge red flag, a big negative signal. On the flip side, the quiet proliferation of Lightning payment apps being adopted by thousands of small businesses globally, whether it's in El Salvador, parts of the US, Europe, Asia,
That's a positive signal.
a strong positive signal. It's probably the purest proxy we have for real-world viability. If merchants are adding support, it usually means they're seeing some demand, some volume, or at least they anticipate it. If they're dropping support, like PayFast did.
Means the HODL paradox is winning out, at least in that context.
Precisely. It's the bottom line for practical adoption. Hashtag tech outro.
So we've really covered a lot of ground here. From the deep cold storage HODL strategies all the way to those hyperinflationary markets where Bitcoin is literally a lifeline.
Yeah, it's a complex picture.
It really is.
Yeah.
But I think the key takeaway, the thing we've distilled from all these different sources and angles, is this. Bitcoin probably can't succeed solely on preservation, on just being digital gold.
While HODling is crucial, it drives that scarcity, feeds the price appreciation narrative.
Right. But long-term success, especially fulfilling that original vision of peer-to-peer electronic cash, it seems to demand finding this really critical balance.
An equilibrium.
Yeah, an equilibrium between preserving your capital, your investment, and actually intentionally using the network, practicing utility.
Because if the asset is never actually used for its intended purpose,
It risks just staying stuck as a purely speculative investment, right? Never quite reaching its full potential as that decentralized medium of exchange it was designed to be.
and maybe this whole conversation forces a bit of, self-reflection for you listening right now. Well, ask yourself, in your own financial life, your own decisions, do you truly think of Bitcoin as functional money, something you could actually use? Or is it really just an investment you hope to sell for more fiat later?
Can it successfully be both? That's the big question.
It is. And here's a final thought experiment for you to chew on. Imagine if every single person holding Bitcoin today consciously decided to allocate and spend just, say, 1% of their holdings each year.
Just 1%. Through a dedicated spending wallet, maybe on Lightning?
Yeah. Small transactions. Would that small but widespread commitment be enough transactional fuel? Would it be sufficient to genuinely speed up global adoption, convince more merchants, and help Bitcoin finally reach that critical mass as usable money?
That is a fascinating challenge, and honestly, we'd love to know what you think. What's your answer to that?
Yeah, let us know.
And hey, if you found this breakdown useful, if digging into why spending Bitcoin actually matters was insightful for you, please take just a second to support the channel.
It really does help.
It does. Go ahead and smash that like button, hit subscribe if you haven't already, and definitely ring that notification bell. It genuinely helps Crypto Robot grow, boosts our visibility in the algorithms, and it lets us keep bringing you this kind of high-signal content every single week.
We appreciate it.
We really do. And comment below. Let us know. Are you primarily a spender? Are you a strategic saver, a HO dealer? Or have you maybe implemented that two-wallet strategy to try and be both? Tell us your approach. We'll read through the comments and feature some of the best takes in the next deep dive.